Hello, Mark Laudi here. You frequently hear people discuss the virtues of trading versus investing. Trading being the very short-term play in the market compared to investing, which is much more about long-term holding. So for now, let's just take a look at whether long-term investing in the Singapore market pays off. Once again, you shouldn't take anything I say as financial advice. As always, check with somebody who is qualified to provide you that advice tailored to your individual needs. But anyway, here we go. So this is how the Straits Times Index has performed. This is a chart which goes back many, many years, and you can see the financial crisis in 2009, 2010 very clearly there with that massive decline. And even in between, even though we've had that very substantial run there from 2003 to 2007 on the left-hand side of that screen, it's obviously a chart that shows considerable volatility. So the multi-million-dollar question is, does long-term investing pay? Well, here is the number. This is the return of the Straits Times Index from February 2004, so pretty much towards the beginning of that bull run, to February 2014. And if you count out dividends, the market has returned, that is the broad index has returned almost 65%. That's excluding the dividends. Now, in order to gain exposure to such a movement, you might like to consider an ETF, an exchange-traded fund. ETFs, by their nature, are passive investments. They don't outperform the market, they don't underperform the market. They give you an almost exact correlation, an almost exact return to the market. In other words, without having to think about picking stocks, you buy the ETF and that way you get that exposure to the market. Remember, talk to your financial advisor first. But the benefits of that is, first of all, that you are able to get execution. You're able to buy and sell the ETF just like any other stock. But it gives you the diversification like a mutual fund, which by definition invests in a number of different securities. In the case of the Straits Times exchange-traded funds, they invest obviously in the 30 Straits Times constituents, representing about 14 sectors. The other benefit of ETFs is that there is a lower expense ratio. Now, usually when you buy a mutual fund, you pay an upfront sales fee of anywhere between 1% and 5%, depending which fund manager you're talking about and who you buy it from. And then there's an annual management fee, which usually also amounts to anywhere between 0.5% to 2 or even 3%. Once again, depends on the fund that you're buying. By contrast, exchange-traded funds, as I mentioned, you don't pay any upfront fee because it's just the brokerage fee and the usual transaction fees with stocks. But you still get the diversification. And then there is this very low expense ratio on an ongoing basis. There are two exchange-traded funds we're going to look at, particularly pertaining to the Straits Times Index. They are the SPDR STI ETF, which was launched back in 2002, and the Nikko Asset Management Singapore STI